This is video 2 of a total of 3 videos. We've just covered case 1, now we will cover case 2. Now case 2, you will notice that the face interest rate is still 10%, but the market interest rate is 8%. So what that means is the company is actually giving 10% return to the investors on their bond investment, whereas the going rate in the market is only offering 8%. So we're actually offering more than what the market is. Now, based on our present value calculations, the actual price that we should be selling the bond for is at 113.59. Now, keep in mind that the percentage signs are left off, so when you do convert this to a decimal, it actually is 1.1358869. Now we would have to do our detailed present value calculations of our principal and all our payments over the life of this particular bond, but this is already done for us. So the first thing we're going to do is figure out the selling price. So what you'll do is you'll take the 1.135 number, multiply that by your principal. And what that basically means is we will issue these bonds for $113,589. So what that means is we are going to receive cash. So we're going to debit cash for $113,589. We are going to credit bonds payable for the amount of the face. So that's the principal amount, so that $100,000. And that difference will be credited to a new account. And our difference is $13,589. That new account will be premium on bonds. And you'll see over here the premium on bonds will have a normal balance on the credit side just like the bonds payable. So these two are added together to get our carrying value. So our carrying value, I'm just going to move this up so you guys don't. Our carrying value will equal the bonds payable plus premium. Then you'll see that it's time to make our semi-annual adjusting journal entry. Now to do that, we need to figure out the amount of the interest payment. Now the interest payment is going to be $100,000 times the 10% times the time. We're still going to use the 10% because that's the face interest rate. We're going to ignore what the market is. We agreed to pay the 10%, that's the contractual rate, and the 10% is not based on the selling price but based on the actual principal. And then again, 6 over 12 for half a year. The interest payment is still going to be $5,000 for this example. So that means the $5,000 is what we are planning to pay to the bond investors on January 1. Keep in mind, December 31st, we're just doing the accrual entry to reflect the amount of interest expense for this segment of time. Now, what we're going to have to do here is we're going to have to amortize a portion of this premium. Since we are using the straight line method, what we'll have to do is look at the $13,589, which is currently in the account. Now, because this is 10 years, there's 10 years and it's twice a year, we're talking about 20 payments. So 20 payments, and let's see, make this real, see it all. 20 payments. So what we're going to do is we're going to take the $13,589 and divide it by 20 payments. So that will be $13,589 divided by 20. That gives us a grand total rounded to the nearest dollar, $679. So that will be our amortization to our premium account. So the premium on bonds will be debited $679, which is actually a decrease to the premium account. And then the interest expense won't quite be the full $5,000 since $679 was was debited to the premium on bonds. So that actually brings our cost, our expense, 4,321, because we were originally able to get a little bit more up front than we have to pay back. So we want to make sure that we properly match that, and since we're using straight line, it's going to be equal amount every 6 months. So on the date of actual payment, January 1, we're going to cut a check for 5,000. So we will debit our interest payable and we will credit our cash for the 5,000. And then let's say July 1 of the following year, what we'll do here, it'll be the exact same entry as the one on December 31st. However, instead of crediting interest payable, we will credit cash on July 1 to reflect the payment of the next interest payment. Now, keep in mind that every 6 months we will be amortizing $679. So over the course of 10 years, you will have 20 $679 debits to the premium on bonds. So eventually, when we get to the very end, the premium on bonds will be zero. So that means your carrying value will be 100,000, which is the bonds payable, the principal amount, plus the premium of zero. So the carrying value will actually equal the principal at the date of a retirement. So what that means is when we actually pay this money back 10 years later, we will simply debit bonds payable and then credit cash for the 100,000, and the premium on bonds will be zero. That concludes the video for case 2. Stay tuned for case 3.